What if I told you that the euro is one of the most traded currencies in the world, yet also one of the most misunderstood? For many traders, especially beginners, EUR/USD feels simple, stable, and even predictable. It's often seen as the safe pair, the one you start with before moving on to something more complex. But that's where the problem begins. Because in trading, what looks simple on the surface is often what costs people the most money. And when it comes to euro trading, there's a clear gap between what traders believe is happening and what is actually driving the market behind the scenes. The easy pair illusion. One of the biggest misconceptions is that EUR/USD is the easiest pair to trade. It's often described as clean, stable, and less volatile compared to other currency pairs. While that may be true on the surface, it doesn't make it easier. In reality, EUR/USD is the most traded pair in the world. This means it is heavily dominated by institutional players such as banks, hedge funds, and large financial institutions. These participants operate with far more capital, deeper data, and more advanced strategies than retail traders. Because of this, the market becomes highly efficient. Price movements are rarely random. They are driven by liquidity, positioning, and broader economic forces that are not always visible on a simple chart. So while the pair may look clean, it requires a higher level of precision, and that's where many traders struggle. The truth about news and price movement. Another common belief is that news directly moves the market in a simple and predictable way. Traders often expect that when economic data is released, price will immediately react in a logical direction. But the reality is different. By the time news reaches the public, much of it has already been priced into the market. Large institutions position themselves ahead of major events based on expectations, forecasts, and probability. So when the news is finally released, the market doesn't react to the information itself. It reacts to how that information compares to expectations. This is why price sometimes moves in the opposite direction of what seems logical. Understanding this changes everything. Because instead of chasing news, traders begin to focus on positioning and expectation, which is what truly drives movement. What technical analysis doesn't show you? Technical analysis is widely used in EUR/USD trading because the pair often forms clean trends and recognizable levels. Support and resistance zones appear clear, and patterns seem reliable. However, what many traders don't realize is that these levels are not just random points on a chart. They are areas where liquidity exists, places where large orders are waiting, and where stop losses from retail traders are clustered. Price doesn't simply respect these levels. It interacts with them strategically. It often moves beyond them briefly, triggering stop losses before reversing direction. This is not random behavior. It's part of how the market functions. Technical analysis works, but only when you understand that behind every level is a reason, and that reason is often tied to liquidity rather than the level itself. The bigger system behind EUR/USD. EUR/USD is often treated as a simple currency pair, but in reality, it represents something much larger. It reflects the economic relationship between two major regions, influenced by a wide range of factors beyond just price charts. Decisions made by institutions like the European Central Bank and the Federal Reserve play a major role in shaping long-term trends. Interest rates, inflation, and monetary policy directly impact how currencies are valued. But the influence doesn't stop there. Global events, investor sentiment, and capital flows between markets also affect price movement. When investors shift money across regions, it changes demand for currencies, which in turn impacts EUR/USD. This means the pair is not moving in isolation. It is part of a larger financial system that constantly evolves. The reality of overtrading, because EUR/USD is always active, many traders feel the need to constantly trade it. The idea is simple. More trades should mean more opportunities, and more opportunities should mean more profit. But in reality, this approach leads to losses. The market may be active, but that doesn't mean every moment presents a good opportunity. Trading too frequently often results in poor decision-making, emotional reactions, and unnecessary risk. Successful traders approach the market differently. They focus on quality over quantity. Instead of trading constantly, they wait for clear, high-probability setups. This patience is what allows them to stay consistent, while others lose money by trying to be active all the time. The reality of euro trading. When you remove the myths, euro trading starts to look very different from what most people expect. It is not about finding easy setups, quick entries, or reacting instantly to every movement on the chart. Instead, it becomes about understanding how the market actually operates beneath the surface. EUR/USD is not just moving randomly from one level to another. It is driven by liquidity, positioning, and the actions of large institutional players who operate with long-term objectives. Price moves to areas where orders exist, where liquidity is available, and where positions can be built or closed. This means many of the moves that confuse retail traders are not accidents. They are part of a larger process. Sudden reversals, fake breakouts, and unexpected spikes are often the result of liquidity being taken from the market before the real move begins. Once you understand this, your perspective shifts. Instead of chasing price, you begin to observe it. Instead of reacting emotionally, you start thinking strategically. You begin to ask better questions. Why is price moving here? What is it targeting? Where is liquidity likely to be? Euro trading becomes less about guessing direction and more about understanding intent. And when you start thinking this way, the market feels less chaotic and far more structured. What actually works? Traders who succeed in euro trading do not rely on shortcuts or simple strategies alone. They build a deeper understanding of how the market behaves over time. They focus on the bigger picture, paying attention to macroeconomic trends, central bank decisions, and the overall direction of capital flow. They understand that movements in EUR/USD are often connected to interest rates, inflation data, and policy decisions from institutions like the European Central Bank and the Federal Reserve. Instead of ignoring these factors, they use them to build context around their trades. At the same time, they still use technical analysis, but in a different way. They don't treat support and resistance levels as guarantees. Instead, they see them as areas of interest, places where something might happen, not where something must happen. They also focus heavily on risk management. They accept that losses are part of trading and structure their trades in a way that protects their capital. They avoid risking too much on a single trade, and they don't let emotions dictate their decisions. Over time, this approach creates consistency. Not because every trade is a winner, but because the overall process is controlled, disciplined, and based on understanding rather than hope. If this helped you see euro trading differently, make sure to like this video and subscribe for more content like this.